It's easy to get lost in the noise of stock picks and hot sectors. So let's step back and look at the big picture. Where will the global equity market be in 5 years? What should we own today to position ourselves for those gains? And how do we navigate between Fed meetings and earnings season? It's a lot to cover, so let's go. The intro numbers, expert level. Valuations. The S&P 500 forward 12-month PE is about 22.1x. That's above the 5 years and 10 years averages of 19.9x and 18.5x respectively. But it's not unprecedented. 2025 to 26 EPS growth consensus sits near plus 10%, plus 13%. FactSet. Insight https://insight.factset.com/sp-500-earnings-season-update-August-8-2025. UTM_source equals chatgpt.com. Income backdrop. The S&P 500 dividend yield is about 1.2%. Not much help there. Europe generally screens higher though, so that supports equity income tilts. Multiple https://www.multpl.com/sp500 dividend yield. UTM_source equals chatgpt.com rates. The US 10-year is about 4.30% as of August 21st, 2025. That anchors discount rates and factor leadership. Reuters https://www.reuters.com/world/China/global markets wrap up on the 21st of August 2025. UTM_source equals chat.com relative value. Investors are reallocating to ex-US on valuation. MSCI US trades at a far higher forward PE than Europe, approximately 14x, and Asia ex-Japan approximately 1/4x. July saw ex-US equity inflows hit a 4.5-year high. Reuters https://www.reuters.com. Business Global Markets funds the 13th of August 2025. UTM_source equals chat.com Japan. A structural reform story. TSES cost of capital push plus record Nikkei print supports ongoing re-rating, especially where PB1X is addressed. What to own now? Framework. Not advice core. Global market cap core with a modest US overweight. Yes, it's rich on a standalone basis. But earnings breadth and AI cash flows drive outperformance in our view. I trim beta though, and insist on quality/profitability screens aligned to high ROIC. Low leverage, satellite tilts, international developed ex-US, Europe for value plus dividends. Japan for governance, let row uplift and buybacks. Selective M, overweight India, Asia ex-China quality growth, be tactical on China. It's a policy-driven swing on both growth and risk. Reuters https://www.reuters.com. Business Global Markets funds the 13th of August 2025. UTM_source equals chatgpt.com. Small caps, only if you expect rate relief. Insist on positive free cash flow and term structure sensitivity. Thematic. Barbell. AI infrastructure and enablers. Compute. Networking. Power. Cooling. Select software tied to productivity. All economy 2.0. Defense. Industrial automation. Grid and power equipment. Select energy/uranium as beneficiaries of capex cycles and geopolitics. Risk controls. Keep duration. And equity risk balance barbell quality equities with intermediate treasuries. Use dynamic hedges options, overlays around macro nodes Jackson Hole, CPI, earnings season. Then I ran 3 scenarios to illustrate total return math. The table below summarizes the inputs. If EPS compounds at 7% and the multiple settles at 19x by 2030, price return sits mid-single digits annually. Add dividends and you're in the high single digits. These aren't targets. just illustrative math. So what are your takeaways? What do you disagree with? Let me know in the comments. This is a public service announcement. Please don't use my face to represent my views. Thank you.